Hi everyone, welcome to a new video. Today we're going to discuss United Health stock. One of the most discussed stocks right now, so let's get into it. United Health Group Inc. is currently trading at around $281 per share, which marks a significant decline from its previous highs earlier this year. The trailing 12-month P/E ratio stands at approximately 12x. This is a substantial drop from historical averages, where United Health often traded at APE between 20x and 25x. The sharp compression in valuation reflects mounting investor concerns about future profitability, regulatory pressure, and operational execution risks. These ratios now place United Health in the value category, although the market clearly sees heightened uncertainty going forward. In terms of other company statistics, the stock's PEG ratio is around 0.5, suggesting that relative to its earnings growth expectations, the stock is not especially cheap. The price-to-sales ratio is near 0.65x, which is low for a large, historically high-margin healthcare company. The price-to-free cash flow ratio is roughly 10.4x, indicating strong cash generation relative to the price. The EV/EBITDA ratio stands close to 9x, and debt-to-equity is moderate at around 0.8. showing that the company is not overly leveraged. Profit margins have fallen to roughly 3.6%, which is below its multi-year average. Return on equity is solid, in the range of 20% to 23%, while return on assets hovers around 7% to 8%. These figures show that United Health still operates a large and efficient business, but the market is no longer willing to pay a premium for it due to several emerging issues. Now let's talk about why the stock is down. This drawdown has not been random. It has come in phases, each with specific catalysts that drove investor concern. The first major leg lower came in April when the company reported disappointing Q1 earnings. Revenue came in at $109.6 billion, slightly below estimates, and EPS came in at $7.20 when analysts were expecting around $7.29. But it wasn't just the miss that caused panic. The real issue was the drastic guidance cut. United Health slashed its full-year EPS guidance from a previously guided range of $29.50 to $30 down to $26 to $26.50. Just weeks later, the company withdrew the guidance altogether, citing uncertainty around costs and ongoing pressures in their Medicare Advantage business. This triggered a one-day decline of nearly 20%. Marking one of the worst trading days in the company's history. Following that, more bad news hit. In May, CEO Andrew Whitty stepped down unexpectedly. While leadership changes happen, the timing was poor, coming right after earnings and amid external tragedy that shook the company's reputation and public image. This created a vacuum in leadership at a moment when investors were already nervous. Then, in July, United Health confirmed that it was the subject of ongoing federal investigations, including both civil and criminal probes by the Department of Justice. These investigations focus on alleged misconduct within its Medicare Advantage billing practices. The stock dropped again, and this time the concern was deeper. Regulatory risk is now real, and if the DOJ investigations uncover serious violations, the company could face massive fines or changes to its business model. Let's now talk about the expectations. Looking forward, revenue estimates for United Health remain solid. Analysts forecast that total revenue will grow around 11% in 2025, reaching approximately $450 billion. This continued growth is expected despite the current challenges, mainly because of United Health's scale and its ability to generate consistent income across both its insurance and healthcare services segments. Optum continues to be a growth driver, particularly in pharmacy services and care delivery. The insurance business remains massive and diversified, which gives analysts some confidence that revenues will hold up. However, EPS estimates have been revised substantially. The current consensus for 2025 EPS ranges from $20 to $22. Just a few months ago, that range was closer to $29 to $30, so this is a significant downgrade. Most analysts do believe earnings will recover, but gradually. The estimates for 2026 sit closer to $24 to $25, still below historical highs, but indicating a potential rebound if cost pressures ease and legal risks become manageable. Margins are expected to remain tight for at least the next few quarters, especially in the Medicare segment. Analysts are not expecting a full recovery until possibly 2027. Despite these challenges, free cash flow remains a bright spot for United Health. The company's trailing 12-month price-to-free cash flow ratio is around 10.7x, which implies a free cash flow yield of approximately 9% to 10%. That's quite strong for a company of this size and suggests that United Health can continue to support its dividend and capital return programs. Operating cash flow in 2024 was approximately $21 billion, down from $25.6 billion the prior year. While that is a decline, it is still a robust figure and shows that the business continues to generate real cash, even as earnings and margins fluctuate. Analyst price targets reflect a mix of caution and optimism. The average target is around $380, implying approximately 35% upside from current levels. Some analysts have lowered their targets recently in response to the guidance withdrawal and the DOJ news, bringing their estimates into the $340 to $350 range. The most bullish targets remain close to $630 or even, which suggests that if the company can stabilize earnings and put the legal concerns behind it, there could be substantial upside over the next 12 to 18 months. However, that recovery is conditional on multiple factors, including cost normalization, regulatory clarity, and leadership stability. One interesting development has been insider buying. In May, several top executives made sizable open market purchases of United Health stock. The CEO reportedly bought $25 million worth of shares around the $288 level, and the CFO followed with an approximately $5 million purchase at similar prices. These are significant insider buys and suggest that management believes the stock is undervalued at these levels. Other board members also added shares to their positions, which further reinforces the idea that those closest to the company are confident in a long-term rebound. Insider buying of this magnitude is often taken by investors as a bullish signal, especially when it happens during a period of negative sentiment. To wrap up, here's my conclusion. United Health has clearly experienced a significant derating. The valuation has contracted, the earnings outlook has softened, and legal and regulatory clouds are now overhead. Despite all this, the company remains fundamentally strong in terms of scale, cash generation, and diversified operations. However, I believe the short-term risks are simply too high to justify initiating a position right now. With Q2 earnings scheduled for July 29th, I think it's best to wait and see what the company says. Will there be more bad news? Will they reinstate guidance? Will margins continue to deteriorate? Or will we see signs of stabilization? Until I have those answers, I will not be investing in the stock. I'll wait until after the earnings report on July 29th to reassess and decide how to proceed based on what they report. Thanks for watching. If you found this breakdown helpful or you're following United Health like I am, drop a comment below and let me know what you're doing with the stock, buying, holding, or waiting like me. I'll be posting more videos like this soon, so if you want to stay in the loop, make sure you hit that like button and subscribe to the channel. It really helps out, and I appreciate every one of you who's joined the journey. See you in the next video. Bye.